So today's webinar is Developers and Subrecipients, the Differences, Procurement, and Other Rules. Designed for NSP grantees and their partners, this webinar will address the distinction between developers and subrecipients, as well as the application of various HUD and OMB rules. You'll learn how subrecipients and developers may be selected and what procurement rules each must follow. The webinar will also cover eligible forms of compensation for developers and subrecipients. And at the conclusion of the presentation, the presenter will review several examples to determine whether an entity is a subrecipient or a developer and why. So there's three main outcomes we hope to achieve with today's webinar. One, that you understand the differences between developer and subrecipient roles. That the different rules that apply to developers and subrecipients are clarified in your minds, and that some of the other rules related to NSP about subrecipients and or developers also are clarified for you. And to help us with this today, we have Stan Fitterman. He's the Chief Operating Officer and Technical Assistance Director for the Florida Housing Coalition. And rounding out the group, especially for the Q&A portion of the webinar, are the familiar NSP managers at HUD headquarters in Washington, D.C., John Laswick, David Noguera, I'm not sure if David's with us today, and Hunter Kurtz. So welcome to each of you. And at this point, I will turn it over to Stan Fitterman. Hi, Stan.
All right. Thank you very much, Kent. I appreciate it. Welcome, everybody. Thanks for joining us here on the webinar. As most of you who are implementing NSP programs know, you've got three groups that you can work with to help implement our programs: developers, subrecipients, and contractors, or any combination of these entities. And depending on which of these three you're working with, different HUD and OMB rules apply, and depending on the specific situation. This webinar is going to focus largely on developers and subrecipients. Before we get into talking about the ins and outs and what have you as it relates to developers and subrecipients, I think it's important to clearly understand the distinction we're making between those two. So let's start with the definition of a developer. A developer is a for-profit or private nonprofit that individual entity that receives NSP assistance for either acquiring homes and residential properties to either rehab for resale or to use for rental housing, for instance, or other residential purposes, or constructing new housing in connection with the redevelopment of demolished or vacant properties. Developers basically are program beneficiaries, and so they're distinct from subrecipients, from grantee employees, and from contractors. And I want to go back to the first part of this definition for a second. A developer has to be a private for-profit or nonprofit. A public nonprofit, such as a public housing authority or a redevelopment authority, cannot be treated as a developer. Okay, let's take a look at what developers do. Developers are basically, you're funding someone to complete a project. They're going to have site control, they're going to pull permits, they're going to manage the project from start to finish. In effect, what we're saying about developers, they need to be entities that are taking on some of the risk of a deal. So complete a project, site control are important, and basically they're the ones that are doing all the work on obtaining the permits and managing that project. Okay, so we saw what developers can do. Let's look at what developers can't do. They can't just be a contractor, and they're not providing specific goods or services back to the grantee. Okay, so we've got what a developer is. So what's a subrecipient? A subrecipient is a nonprofit or public agency that assists a grantee or another subrecipient for administering all or a portion of the NSP program. So basically, a subrecipient is someone that's implementing a part of the program just as if they were the grantee. It includes any nonprofit or any unit of local government that receives from a state grantee. And it also includes any land bank that receives NSP funds from a grantee or another subrecipient. So We've got distinctions here. This is someone who is implementing a portion of the project, as opposed to a developer who's taking risk and doing a deal. Okay. As we said before, that public nonprofits are not considered, cannot be a developer. They can only be a subrecipient. This is in the CDBG rules 24 CFR 570-202, as it's cited here. It says program beneficiaries are limited to private individuals and entities. So as a result, if it's a public nonprofit, it has to be treated as a subrecipient. One more issue on the subrecipient definition is that if a private nonprofit is part of an NSP2 consortia, they have to be designated as subrecipients. They cannot be developers. So that's regardless of what they're doing. If they're part of an NSP2 consortium, then they are subrecipients. General subrecipients act as an extension of the grantee, and they've got to follow all the same rules as grantees. And in a minute, we're going to get into what some of these rules are that they have to follow. Now, we talked about private nonprofits being able to be developers. Private nonprofits can also be subrecipients by implementing a portion of an NSP program, and that is when they're doing activities that don't meet the definition of a developer. One of the most common examples we see in the NSP program is housing counseling. In these cases, the private nonprofit is treated as a subrecipient, and if they're acting as both a developer and a subrecipient, so for instance, you have a nonprofit that is doing the development activity and also providing housing counseling, you need to have two separate agreements. As we're going to see in a couple of minutes, the difference between procurement rules and how each can be compensated, it just isn't possible to have one agreement that covers when they're acting as a developer and when they're acting as a subrecipient. So a private nonprofit can be both. If they are acting as both, you've got to have two separate agreements.
Stan, can I interrupt for just a second? We're having a little bit of strange audio on your end, and I'm wondering if you're using a handset. Or
no, I'm not.
Okay. We will look for something else. And basically, it's okay, but it garbles a little bit at times. But,
okay.
We'll see what happens.
Okay. I'll speak loud and clearly if that helps.
That always helps. Good. Thank you.
Okay. Okay, so let's take a look at a summary, a nice picture of what I just said. So who can be what? A private for-profit can be a developer, can't be a subrecipient. A private nonprofit can be both a developer and, as we just talked about, can also be a subrecipient. A private nonprofit part of a consortium cannot be a developer, regardless of what they're doing. They can be a subrecipient. A public nonprofit can never be a developer, can be a subrecipient. And the same with a public entity. They can be a developer. They cannot be a developer. They can be a subrecipient. So let's go back to private nonprofit. For a private nonprofit, it doesn't matter who you are. It matters what you're doing. You're acting like a developer, you're a developer. If you're taking on the role of a subrecipient, you're a subrecipient. For a public nonprofit, such as a housing authority or a redevelopment authority, it doesn't matter what you're doing. It matters who you are. Because you're a public nonprofit and not a private entity, you've got to be a subrecipient, not a developer. Okay. Kent, do we have any questions lined up, or should I keep?
At the moment, we do not.
Okay. Okay. Selecting a developer. Developers may be chosen by grantees or subrecipients based on qualifications. A competitive process is not required by the NSP program. However, some state or local rules require that a competitive procurement process be used to select a developer. And even though it's not required, most grantees can choose to use a request for qualifications or an RFQ process to choose a developer. Okay? Even if you use a procurement process, it doesn't change the developer into a subrecipient. If they're doing development type activity, they are a developer. And if you layer on, we want to use a procurement process, they still are treated as a developer just because even though you added on a layer of having them go through a procurement process. Okay, so we understand, let's move on. Okay, selecting developer, it's continued. Okay, grantees need to negotiate both a fee and the process with what they're working with the developers. And it's extremely important that you have a scope of work and that it's really clear what you expect out of this developer. If rehab is involved, you can often refer to the rehab standards here. I can't stress enough how important it is that the scope of work, the expectations of you, the grantee, be clearly laid out, and that the developer understands what the expectations are. A lot of problems we see between grantees and developers is when that scope of work and in the developer agreement isn't very clear on what the expectations are. The grantee or subrecipients need to ensure that the cost and the developer fees are reasonable. And to do this, you need to underwrite the project, which includes having someone evaluate the cost, estimate what the project income and expenses are, and weighing the risk and rewards so you can calculate what an appropriate fee is and what is reasonable within your market. Once the fee and the process are finalized and the specifics are put into agreement, it's executed by both the developer and the grantee. And it's this agreement that is the legal document that you're going to rely upon, especially if there's to settle disputes, as well as to determine when a draw is earned and when a developer fee is earned. As we note here, developer agreements often are the basis for evaluating program expenditures during monitoring reviews. So if you pay for something that's outside the agreement without a revision to the agreement, or if the agreement calls for the developer to do something that isn't done, it's likely that this is going to show up in a future monitoring report. And a number of monitoring findings that we see are ones where people don't follow their own rules. So it's important to make sure a developer agreement is thorough, has what the expectations are, has when the fee is earned, has things such as when how change orders are handled, and when the project is done, when it's completed. The developer agreement's got to be executed before you commit an SP funds. And some examples of the terms of developer agreement, as we talked about, a detailed scope of work. How long does the developer have to complete the development? Are there any penalties if they don't complete it on time? What the budget is for the various line items that need to be undertaken? Who's responsible for marketing the units, whether for sale or for lease when the unit activities are completed? What are the eligible activities? What are the eligible expenses? What target area can they work in? What's the developer fee, as we talked about? And what's the terms of the ultimate buyer financing at the end? Are they going to be fixed rate, 30-year term, hopefully? What's the terms of the NSP award? Is it a 100% NSP financing? Are you going to expect the developer to go out and get some debt? What are the federal, state, and local compliance issues need to include? And I think something that's very important here is that if you've got a sound policy and procedures manual, a lot of these issues that we're talking about that we just mentioned are often covered in a policy and procedures manual, so this developer agreement can be simplified by referencing the manual. Okay, let's talk about money. Developers are compensated for their work through a developer fee, and the developer fee includes a reasonable profit margin. And I want to stress that this is true for both for-profits acting as developers as well as nonprofits acting as developers. One of my favorite quotes is that nonprofit is a tax status, not a business model. So if you have a nonprofit that's taking risk by being a developer, they are able to recoup a small, reasonable profit through the developer fee. The amount of the fee and when it's paid needs to be clearly laid out in the developer agreement. Okay, Ken, are there any questions yet, or should I keep going?
We do have a question, and
okay.
It is from Julianne, and let me unmute you here, Julianne. Hi, where are you calling from?
Oh, hi. I'm calling from Hartford, Connecticut.
Terrific.
And, I was just wondering, is it necessary to have a development agreement for each individual project we're doing, especially in a city like ours where we're doing a lot of single and two-family homes? Do we have to have one for each property, or if we are doing numerous properties with one developer, can we just have kind of an umbrella agreement?
From a practical standpoint, I think you would, a lot of the boilerplate language may be able to be similar, but I would imagine you would need a separate budget and at least, and perhaps scope of work for the individual properties. If John or Hunter want to weigh in on this as well.
Scope, especially. This is John. You need to be able to keep the requirements and the budgets separate, but to the extent that the rest of it is just kind of repetition of standard boilerplate language, I don't see a big need to separate that out, but you really want to be able to know which project you're talking about and have it accounted for.
So now, if we had a subrecipient agreement with these developers, and I guess we didn't. So we actually don't have a developer agreement on all of the different properties. We have a subrecipient agreement that we had as overarching. Kind of that's what our umbrella policy was. Since that's binding the developers to the agreement or to the terms given from HUD as well as from our state office, would that be sufficient to say, although we do collect budgets and we issue commitment letters based on the individual budgets for each specific project, is it enough that we've bound the developers to the stronger and more restrictive language of the subrecipient agreement?
Well, this is John. I think the requirements are different. So they're either a developer or a subrecipient, but you're kind of trying to make them both, and I think it would result in confusion over which. So there's some key differences that Stan will go into, but let's just pick procurement as one of them. I mean, if you've got a subrecipient, they have to follow the same kind of public procurement rules that you do. A developer doesn't necessarily have to do it that way. So if you're sticking the subrecipient language on them, they might think they can do it differently, but their contract's not going to say that. And then you really don't have the benefit of a little bit of extra flexibility that a developer has in this scenario. So I think you just got to decide which one you're more comfortable with. You can go either route, but if you decide to go the developer route, it is a little more. They do have a little more flexibility. Therefore, they can maybe, potentially make a few more mistakes. And if you're not comfortable with that, then don't do it that way.
Thanks for that question, Julianne. And Stan, I see no more questions at the moment, but
Okay.
keep questions coming.
Okay, so let's talk about developers and program income. Developers are not required to return excess revenues. Now, having said that, you need to make sure that as a grantee that you have mechanisms in place which prevent undue enrichment. For example, if you have a rental deal that can support debt, you perhaps could provide your NSP funds as a direct loan as opposed to a straight grant on rental projects. And this undue enrichment part is really when we talked about using underwriting process to make sure the developer fee is reasonable. The underwriting process is used here as well to make sure that any program income received by the developer doesn't result in undue enrichment for them. As John just mentioned, developers don't need to procure their contractors and do not need to follow the OMB cost principles. As you said earlier, they're treated as direct beneficiaries of the program, and therefore those cost principles and the procurement requirements are not triggered. The grantees, however, do need to ensure that the developer's costs are reasonable and they've got records to demonstrate how they made this determination. Let's get cost reasonableness now. So you can require a developer to receive quotes from third parties to be able to show that their costs are reasonable. And again, even because you're putting a layer on a developer that is usually associated with a subrecipient, that doesn't change their status. They're still a developer, but you're saying in order to make sure the costs are reasonable, we want you to get quotes. You can also use published construction data, and often if people use this, they hire an outside party to go look at, compare what the costs are for this proposed development versus what the market in that area, what the market is, what the prices are rather in their market. And as we noted, the developer does not need to demonstrate that a competitive bid took place. Okay, are we questions or move on?
Sure. Yeah, let's go to Marlene. Hi, Marlene.
Hi.
Hi. Where are you calling from, and what's your question?
I'm calling from Detroit, Michigan, and my question was regarding, is there a reasonable fee or percentage related to a developer's fee?
This is often, a kind of a market where you are and what they are doing. For single-family units, I traditionally see developer fees ranging in the 8 to 12% range, with 10% being fairly common for single-family development. For multifamily development, again, you got to kind of base it on what they're doing, what their scope of work is, how much work they're having to do, how much risk they're taking. But often I've seen folks follow what their housing finance corporation uses for housing credit deals. Sometimes they back off on that a little bit because these deals have a little bit less risk and a little bit less complexity to them than a housing credit or a bond deal. And those usually are in the 14 to 16% range for multifamily deals. But a lot's going to depend on what they're doing, how much risk they're taking, and what fees are in your market.
Okay, thank you.
Thanks. Thanks, Marlene. And Krista is interested, wanting to know if the definitions of developer and subrecipient are the same as applies to the home program.
I always have to look. John or Hunter, I don't know if y'all want to weigh in on this one.
Well, I don't think that, I don't know that well. I thought the home program has CHODOs, which kind of are developers. They're development organizations. I don't know their rules well enough to know how they treat them. Our developer definition comes from the CDBG regulations, and it actually comes from the rehab section. I mean, there's probably some similarity, but I don't know if there may be some fine points that are different. I think the subrecipient definition is pretty close.
Yeah, I think so as well, and I think it is addressed in the specifically in the home rule. Okay.
Let's see. Let's go to Carl. Hi, Carl. Where are you calling from, and what's your question?
Sunrise, Florida. I sent my question in, but let me just repeat them both. Actually, it's in the form of two questions. First question is, doesn't a developer still have to have a procurement policy in place? And second, I required my developer to have a procurement policy, and when he gets paid, he sends me a drawing. He still sends me receipts and canceled checks for everything. And am I overreaching?
Well,
developers don't. John, you want to jump in, or?
Go ahead.
Okay, I was just saying developers don't have to have a procurement policy, but you can, in order to assure cost reasonableness, have them get quotes, but they don't have to go through procurement as per OMB circulars and through the CDBG regs.
Yeah, I think one of the big reasons that we have these kind of procurement policies and public bidding and so forth is that it's the cleanest, most open way to get at making sure that you have reasonable costs. But it's not the only way to do it, and so you do have to demonstrate that your costs are reasonable. But there's more than one way to do that. As far as the receipts, I don't know. I mean, if it's not really slowing you down, I wouldn't think it's a problem. I don't think you absolutely have to, but I think that it's not a bad policy. I don't know, Stan. What do you think?
Yeah, and well, I guess Carl, I know being in Florida, you probably also get a release of liens as well. And I guess my question for you is, do you have them send you the receipts and the checks before you'll reimburse them, or do they have to send you the canceled checks after you've reimbursed them and they've paid their?
No, everything comes in. Stan, when I get the reimbursement, the process is fairly straightforward. We do multiple draws, and for every draw, they have to document that it's in the original project contract for the project. They have to show me the receipt and the canceled check, which they do. In the final draw, they'll show me release of liens and inspection. So we're pretty strict on them, yeah.
The developer has to pay for it before you'll send them any money.
Yes.
Okay. So one issue that I've seen with that, especially with nonprofits, is that they often don't have the cash to be able to do that, and so as a result, they either have to borrow money, and then which increases their cost by having a line of credit, or sometimes they do things they shouldn't and say things were paid when they weren't. So I have often also seen some of your colleagues, when the receipts come in, pay directly to the contractor doing the work. If it becomes a problem where you've got nonprofits that don't have access to the cash in advance.
Well, I'm blessed with a nonprofit that has access to the cash and a good contractor working for them too.
Sounds good.
Okay, thank you, Stan.
All right.
Thanks, Carl. And yeah, go ahead, Stan.
Okay. All right. So selecting a subrecipient. They also can be done designated by an NSP grantee without a procurement process, again, unless you've got a procurement process that's required by law. But again, usually we see folks using some kind of request for proposal, request for qualifications in order to select a subrecipient. Okay. We talked about developer agreements. Let's talk about subrecipient agreements. Again, you need to have a written agreement between the grantee and the subrecipient. And in the rules, there is in 24 CFR 570.503, there are minimum standards that have to be in there. Most of them are things that you would want even if they weren't minimum standards required by rules, such as what they're going to do for you, what records and reports they have to send back to you, because you, of course, have to send records and reports to your funder, to HUD, how you're going to treat program income, which we're going to talk about in a minute, how that has to be treated, the fact that they have to follow the uniform administrative requirements, the OMB circulars, and other program requirements. What happens if they don't comply with the term of the award, how you're going to suspend it, how you may terminate it, and that at the end, upon expiration of the award, the subrecipient is going to transfer to the grantee any CDBG funds, any NSP funds on hand at the time of expiration, and also any accounts receivable. Okay. Questions, Ken, or should I keep going?
Keep going.
Okay. So, how do subrecipients cover their cost? Grantees and subrecipients cannot earn a developer fee. I want to say that one more time. Grantees and subrecipients cannot earn a developer. They are compensated for their actual cost of carrying out the eligible activities. And the compensation is limited to activity delivery costs, which we're going to talk about in a second, and when applicable, and program administrative cost. By being reimbursed for actual costs, this reduces or eliminates development risk. So if actual costs exceed estimates or there's holding cost, there's going to be administrative or activity delivery that covers that. So the accounting principles and cost circulars don't allow grantees or subrecipients to also collect a developer's fee. And I want to point out, this is a CDBG policy that's been around for decades. So this isn't the NSP staff sitting around thinking up ways to handle this. This has been in place for literally decades, that subrecipients and grantees are not allowed to eligible for developer cost. Okay, so what are activity delivery costs? These are costs for incurred in carrying out very specific NSP-funded activities, such as engineering costs, design costs related to a specific activity. Staff and overhead costs directly related to carrying activities are also eligible activity delivery costs. Now, for the sake of time, I'm not going to give you I'll give you a citation in a minute that provides a lot more detail on what's activity delivery cost and what's administrative cost. Speaking of administrative costs, so NSP regs, as many of you are aware, allow reasonable admin costs and carrying charges related to planning and executing the program. It's 10% of the award amount and 10% of program income earned. Okay, some examples of administrative costs: salaries, office space, staff time doing policies and procedures manuals, administrative services provided under third-party contracts, such as legal work, your audit. Those are all considered administrative costs. Now, as promised, there is a really handy chart in this May 18th, 2012 policy alert, Guidance on NSP Activity Delivery and Administrative Cost, and it breaks it down in two ways: by task in the development process, pre-development, construction, post-development, and the functional role of the grantee or subrecipient. And it lets you know which activities would be considered activity delivery cost and what would be considered admin. And I have found this to be extremely handy little chart. So I'll give folks a second, but these are available on the NSPTA website, and if there is a policy alert notebook that was published in June that has all the policy alerts from the mid-June back to the beginning of time. Okay. All right. So let's talk about program income. This is gross revenues received by a grantee or subrecipient generated from the use of the NSP funds, and it's got to be either returned to the to the grantee, or if the grantee wishes, the subrecipients can keep the program income and use it for other NSP eligible activities. look at some common sources of program income. We've got payments. If you made a direct loan with NSP funds, the payments of the principal and interest back to you is program income. Proceeds from the sale of properties acquired and or improved with NSP funds, and if someone sells a home before the end of the affordability period, the amount of money you recapture is also considered program income. The interest earned on program income while you're deciding what to do with it is program income also. And the gross income from rental property you developed with NSP money minus the cost of minus operating expenses is program income. So the cash flow from rental properties is considered program income. And this is where we're kind of getting back to underwriting. You would want an underwriter type to look at the sources and uses and the operating pro forma rather, and determine what is reasonable expenses for operating the property and how much cash there is at the end. Most folks look at this at an annual basis with a rental property and calculate what the program income is at the end of a year.
As an annual activity.
Correct.
And this is a good place to take Marcia's question regarding program income and developer fees. If a consortium member, so this would be NSP2, enters into a partnership with the developer for a multifamily project, the project is now complete, can the developer receive a portion of the rental income?
Well, I think that depends on the underwriting more than anything else. But I guess, I think a subrecipient could receive a portion of the rental income too. It's the developer fee and the way the developer works that's different. So it seems to me that in the operating phase, it's less critical, I guess. But you still have to ensure that whatever they're receiving is an appropriate amount for whatever services they're providing.
And right, I think also you probably would want to take a look at what the ownership structure is of the property, and how much rental income would be going back to the developer, and how much of it should be program income.
This is John again. So even if you had a developer and the developer were keeping some or all the program or the revenues, you need to calculate during your underwriting, up front, how that factors into their rate of return. So if they're going to retain all the excess revenues as a developer, then probably their fee should be lower. And I would think the same kind of thinking would apply, if you've got a subrecipient coming in or some sort of a hybrid situation that you've described. At that point, it's really more about not, overcompensating them than it is about the type of entity they are, I believe.
All right. Am I moving on, Kent?
Sure. Yep. Go ahead.
Okay. Okay. So subrecipients, we talked about developers do not need to follow procurement rules and do not need to follow cost circulars. Subrecipients must follow CDBG procurement rules at the citations there, and subrecipients must also follow the procurement rules. Part 84, A122 for nonprofits, and A87 for public entities. So if you have a subrecipient, they don't have a choice. They've got to follow procurement. All right, and back to our handy chart. So procurement requirements by entity. If you're a for-profit, you can be selected without a federal procurement process, and you can select your contractors or other partners without a procurement process, remembering what we said previously about cost reasonableness, and quotes may be one way to prove cost reasonableness. Not the only one, but one common way. Private nonprofit acting as a developer, no procurement can be selected without federal procurement, and most people do use some kind of RFQ, RFP process, and they may select their other contractors or other partners without following a formal procurement process. Private nonprofit acting as a subrecipient, again, as you can see, all of these can be selected without a federal procurement process by the rule. It doesn't mean you should, it just means they can. And they can select contractors. They cannot select contractors without a procurement process. So subrecipients must follow procurement and must follow cost principles. The same with a public nonprofit. As we said earlier, it's private entities that can be developers. A public nonprofit, such as a public housing authority, such as a redevelopment authority, they have to be subrecipients. So they can be selected without the federal procurement process, but they cannot select contractors or other partners without following the procurement rules. Same thing with a public agency. They have to follow procurement when choosing their contractors or partners. But everybody on the list can be chosen without following federal procurement. Most people don't do it that way. Okay, and just to fill things in, definition of a contractor, because we talked about it in one of the first slides and didn't spend much time on them. They are an entity that supplies goods and services at agreed upon rate or price. In the NSP world, we're mostly talking about construction contractors is the most common, others as well. They don't receive activity delivery. They get to charge actual hard and soft costs, and they can earn a reasonable overhead and profit as approved by the grantee that's in the contract. All right, so let's summarize. Developer, private for-profit or private nonprofit. Public nonprofit can't be one. A private nonprofit in a consortium, NSP2 consortium member, cannot be a developer either. They need to have site control. They've got to plan, obtain permits, and manage the program. They need to take on some of the risk of the deal. They don't have to follow federal procurement. They don't have to follow cost circulars. They can earn a developer fee, and the excess revenue is not program income, but we need to make sure that they're not getting unduly enriched from excessive program income coming back in relation to their risk and what the market generally values what they're doing. Okay, subrecipients, public nonprofits, no matter what they're doing. So remember we said private nonprofit, it doesn't matter who you are, it matters what you're doing. A public nonprofit, it matters who you are, it doesn't matter who you're doing. So a public nonprofit is always going to be a subrecipient. Federal procurement applies, cost circulars apply. They can't earn developer fees. They can earn activity delivery and admin. Any excess revenue is program income, and it's got to be returned to the grantee, or the grantee can let the recipient keep it as long as it's used for NSP-eligible activities. Okay, let's wrap up with just a couple of examples. We've got an NSP grantee that gives funds to their PHA to acquire and rehab 33 units of rental housing. The PHA is going to have site control, they're going to obtain permits, they're going to manage it from start to finish. They're doing things that developers do, but they are a public nonprofit, and therefore they've got to be a subrecipient. Another example. We've got a nonprofit that's funded to acquire, rehab, and resell 35 single-family homes, site control, manage development, blah, blah, blah. They're doing all the things we said are a developer. They're also going to have home buyer counseling for potential buyers. So, in this case, they're acting as both a developer and a subrecipient. So we've got to have two separate agreements with them. One developer agreement that outlines what they're going to do, the expectations, the scope of work, and how they're going to get paid when they're doing their development activities. And a second agreement that outlines the scope of work and all those things we mentioned earlier and how they're going to act during their subrecipient agreements, when they're doing their subrecipient activities, rather. And finally, we've got a private nonprofit that's a member of an NSP2 consortium, doing development, owning a site, managing it. Everything we said makes them a developer, except we just said they're part of an NSP2 consortium, so they can't be a developer regardless of the activities they're undertaking. They're going to be a subrecipient. Right. Any questions, Kent?
We do have some questions, and
okay.
Let's see. Let me give me a second here to bring this slide back up. Remind you how to ask questions. You can do it verbally. You can do it in writing. Let's see. Let me go to Steve, and I'm going to unmute you, Steve. And where are you calling from, and what's your question?
Denver, Colorado.
Very good. Go ahead.
I just want to clarify that a private nonprofit can take a developer fee in a mixed-use project, allowing that the work that's done is on a portion of the project where non-federal NSP funds have leveraged to make the project happen, and especially if the non-federal funds are the majority of the funding.
Well, they're not part of an NSP consortium, and you would also want to take a look at the percentage of the developer fee that's coming from the work they're doing on the NSP funded side versus what percentage is coming from the work they're doing on the non-NSP funded side.
There would be no funds, no developer fund received on the NSP portion of the project, only on the non-NSP funded portion of the work. All of the work scope would be on the non-NSP portion of the work.
So you're getting them for free?
I'm sorry, I don't understand.
Well, the NSP program is getting development services. It's funding some of the development, but it's not having to pay any of the developer fee. Is that my understanding?
First of all, we are an NSP2 consortium member. The intent is to build multifamily units and take program income only as a member on the multifamily portion of the project. On the commercial portion of the project, we would be paid a developer fee for services rendered utilizing non-federal NSP2 leveraged funding in conjunction with a regular developer, for-profit developer.
John, I don't see a problem. If they're taking a developer fee from that is not from NSP sources.
Yeah, we've said that's okay, Steve. There's any number of sort of mixed financing deals out there that we're coming in as a gap on the tax credit deals and things like that. So just I guess the only precaution I would suggest is that you're not sort of bending the fees to sort of squeeze all the developer fee into the non-NSP part, and that you're kind of getting around it that way. I mean, if you could get paid some activity delivery costs for the NSP portion of the activity, and then fees for the non-NSP portion, and just have them be separated and defensible from a cost standpoint.
Understood.
Okay, thank you, Steve. And let's go now to Suzanne. Hi, Suzanne. What's your question?
Hi, thank you for taking my question. I was wondering if a county owns some properties and they're wanting to dispose of them, convey title to a subrecipient, they don't have to go through any type of procurement to select that subrecipient or advertising?
That's correct. They don't. But as Stan has said, at least most public agencies tend to go through some sort of a process, just because it's a little cleaner for the elected officials, and nobody wants to kind of be on the spot so much. But yeah, if there's one entity in town that's capable of handling this, you don't have to go through the sort of motions of a procurement process, and you really don't. I mean, we added that citation from the CDBG regulations because most people think you have to procure subrecipients, and you really do not have to, as far as HUD is concerned. But so
that CDBG regulation, it was posted on a previous slide, the one that had to do with developers.
501, yeah, there's a 501 something.
And it's also in the June 1st, 2012 policy alert on procuring developers and subrecipients.
Okay.
If you can't find it on the slides, it's in there, and that's available at the NSPTA, HUD.gov/NSPTA website in the policy alerts.
Right.
Okay.
Mostly what people are doing is requests for qualifications, because that's really what you're trying to figure out is who's capable of doing this sort of work. And so if you do go that route, it's less time-consuming and complicated than something like a full construction contract bidding process or something like that.
Right. Okay. Thank you.
Thanks, Suzanne. And let's go now to Verna. Hi, Verna. Where are you calling from, and what's your question?
Can you hear me?
Yes, we can.
Great. I'm calling from Memphis, and basically my question is program delivery costs. Is this eligible for private nonprofit developers?
Program delivery, you're talking about activity delivery?
Yes.
Yeah, that's something that would be paid as part of the development costs in a developer project. It's only an activity delivery cost when it's a subrecipient or a grantee that's doing it directly. So, I mean, but developers getting paid for that work. This would be the supervisor on the site, or the person that's doing the project development, the people that have that are getting their hands dirty running these projects. Those people all get paid. In a private developer kind of environment, they are paid as part of the development budget. In a subrecipient arrangement, they are paid as you have a development budget, and then you have the activity delivery costs.
Right.
But not both at the same time.
Okay, I was looking at the HUD alert chart that was referenced, and I was somewhat confused still in that area. I guess I'm not necessarily asking the correct question. I guess I'm still trying to figure out with a nonprofit, how do you handle, like we said, the risk may be low. How do you handle that administrative overhead that they carry when carrying the pre-development expenses? Does that make sense, or
right.
Do you understand my question?
I think there are perhaps two. One is that if their overhead costs need to be factored into the developer fee when they negotiate with you a developer fee.
Okay.
And the pre-development, such as engineering to design a parking lot for a rehab unit, or engineering for the drainage for some single family or anything like that, any engineering costs, those are line items in the construction budget, and they're paid for out of the construction.
Right,
the money
but
being
let's
used
say, for example, if the project is under design, and that developer is having to coordinate all of that effort to get it to construction, and so it would be their staff time. You're saying that all of that should be factored in their developer fee, correct?
When they're negotiating their developer fee with you, that's what they need. That's what the developer needs to be thinking about is,
okay,
how much do I need to cover this?
Okay.
And you need to be thinking about, is this reasonable based on the market, or are they are there things they're trying to include in overhead that are part of the total development cost, or are their overhead too high? Is their overhead reasonable, consistent with the market?
Right. And again, I think someone mentioned it earlier, when they're nonprofits, they're just barely getting by. And so it's like, how do you substantiate, and of course you would have to look at an allocation timesheet, I would guess, to just got to get a sense of how much is staff or overhead is involved with this specific project over other projects that they may be involved in. Does that make sense? Or
usually no. Usually the developer fees are represented as a percentage of development cost.
Right.
And that's usually what's used to determine how much their fee is going to get and when they get it. If they are, sometimes a challenge with some nonprofits is they are too undercapitalized, or in for-profits for that matter, too undercapitalized to be able to do a deal of the magnitude that they are undertaking.
Okay.
And sometimes as a funder you can't fix that.
Okay. All right, you answered my question. Thank you.
Thank you, Verna. Who's up next? Looks like we've got a question from Shannon, but Shannon, your hand's up, but I can't unmute you because you have no phone icon next to your name, so you might want to send your question in written form. Bob asks, can a private nonprofit consortium member have a minority equity interest in a for-profit developer?
Could you repeat that? I'm sorry.
Sure. Can a private nonprofit consortium member have a minority equity interest in a for-profit developer?
I guess it's hard to answer that without knowing all the details. One thing that comes into my mind is whether or not it all conflicts with their 501c3 status. So I think there would have to be some more detail on that. I don't know that there are HUD rules, John, that would prohibit that. I think it's more of a IRS question to me.
Yeah, we've had this question a couple of times. It's a kind of tough one. I mean, I guess what I wonder is what's the benefit here? I mean, if it's a way to sort of get a portion of the fees or get a portion of something that you shouldn't be really getting as a subrecipient or or nonprofit or consortium member, then I don't think that becoming part of another entity is the way to do that. If it's just to support that and you're not taking fees, maybe you own the real estate or something like that, and there's no kind of, it doesn't look like you're trying to make an end run on the regulations, then it might be okay. But I agree with you, Stan. It's a little hard to answer outside of the details of the particular situation. But I mean, I don't know. It makes me a little uncomfortable because it sounds like something's trying to sneak by here, and so. If you can convince me that that's not the case, then maybe we can make it work.
We've got a question from Leslie, who's asking for a definition of committed, as in a developer agreement must be signed before funds are committed.
Yeah, that's. I'm going to take the blame for that one. I mean, I think what. It's a chicken and egg, but I think that what we were trying to say with that one was that you've got to know what your deal is before you enter into that agreement. Now, you can't. Then there's the committed in terms of your funding and so forth. So obviously you can't commit yourself to a development agreement before you've cleared your environmental review and those sorts of things. But I think what I had in mind on that with that particular word is more of, you have to know what your deal is before you can actually pin it down. before you can actually proceed. I mean, you can't make a commitment to the project, a financial commitment to the project, and then figure out how it's going to work.
And while we're seeing what other questions might come in, let me remind you that this webinar is being recorded, and it'll be placed on the NSP Resource Exchange in the archives there. It'll include an audiovisual recording of the day's event, along with a PDF version of the slides, and also a written transcript. And the transcript usually takes a little bit longer to get in there, but it's pretty quick. And also, we've got a couple more webinars on the docket, and I believe more will be being added soon. Another one next week on the National Mortgage Settlement, and in mid-August, another open forum Q&A webinar. Looking for other questions, seeing what might be out there. No, it's a kind of a complicated set of rules, and trips people up from time to time. The questions so far have been good, and let's go back to Verna. Hi, Verna.
Hi there again. I don't know if this is appropriate to ask any clarification questions on the chart from the which talks about allowable costs in NSP with acquisition and rehab, or if it's not, then please guide me who I can contact if I had any questions.
Okay, we
on the chart.
Can try. Which chart?
It's titled Allowable Costs in NSP Programs with Acquisition and Rehab. And I believe it was on the recent policy alert dealing with allowable costs between developer and subrecipient, page 7. And if this is not the appropriate time, just guide me who I can contact later.
Oh, we can try. Go ahead. I mean, I'm game.
Okay. There is a one-page, page 7, that at the top it says administrative costs for grantees and subrecipients, and then it talks about contrasted with overhead and profits covered by a developer fee. And so I just needed clarity on this because, again, it talks about part of the development cost versus reimbursable by NSP. And in the block where it says contrasted with overhead and profit, it says that profit is allowed as a reimbursable by NSP. So I was somewhat confused here because, again, I thought that if it's a developer fee that you can't charge the developer's office expense as an allowable portion. Is that an accurate statement or assumption of this chart?
Well, I think the office expense would be, or the part of it that's attributable to this project is part of their overhead, which is part of the developer fee.
Okay. Because the word contrasted with, again, I guess it was contrasting it with the administrative costs for grantees and subrecipients. I'm assuming that's how what was the intent of this particular chart.
Yeah, I think I know which one you're talking about. That's from more like January of 2011, although I think we updated it, so I don't remember the exact.
Okay. Well, I'll look for the update. I just wanted to be clear because it was, at least for me, it was a little bit confusing.
Right. The update, I believe, was May 2012.
Okay. I'll look for it. Thank you.
Yeah, it's a complicated area, and we had another question on here about, what about contractors that have an identity of interest with developers? So, as if you're not already confused. And this is why we're having these things. So it's kind of like one of those Russian dolls. And so sometimes you have not only the developer and the developer's costs. And so generally speaking, the developer fee is profit and overhead. That's all it should be. Now, people build other things into it, and as long as you know what you're building in, there's nothing necessarily wrong with that. But that's really what it should include. Everything else really is a development cost, and if it's a legitimate cost, it should be in the development budget. And then, as Stan said, then the fee, the profit, and the overhead is based on that amount, on that total development cost. Sometimes you have, and it's not unusual to have developers that have an affiliate or a wholly owned subsidiary or a partner or something that they control that is a contractor, and it's allowable to have the contractor receiving overhead and profit on the contracting piece of it, just as if they were a third party. But you just have to be careful that the amount of those fees and that overhead are reasonable in relation to the work that they're doing, and that there isn't sort of double dipping going on between the developer fee and the fee that the contractor is getting for the contracting work. So, whereas if a developer is going to oversee the construction directly, they're going to have a little bit higher fee because they're doing both of those things. They shouldn't have that same fee if they have an affiliate that's doing the construction part of it. So you really got to pull these things apart, and we have a form of technical assistance that we can get going with you really within a week or so to underwrite these projects, and we have some capable TA providers, including the National Development Council, which, as you know, does this stuff week in and week out, so that most of us are not experts at this, and so you shouldn't feel like you have to be. If you get into this sort of situation and realize that you're being expected to make deductions and comparisons and things that you really just don't have the basis for, right into the resource exchange and ask for some help, and we can assign somebody within a week generally to start working with you over the phone. And if it's sort of a monster project, we can expand that and have them come on site. So what you can get out of this, and Verna's a good example, is she knows what she's uncertain about. She's not 100% sure of the answers, but she's on to some things that make her a little bit nervous. And if you don't have somebody in your community, a lender that you're working with, or somebody that's an expert in the nonprofit world or something like that, then get some help through the TA that we provide for no cost.
Thank you.
Thanks, Verna. And who's next? Let's go to Tatiana in Miami Gardens, right?
Yes. Hello, how are you?
Hey, how are you?
Fine, thank you. Good to hear you all again.
You back from Spain?
Yes, I came back Saturday. Had a great time. Hey, this is my question. I have a developer's agreement, and we agreed to a 10% developer's fee. However, as one of my new jobs back here, I received one of their budgets for one of the properties that they're going to rehabilitate, and they are charging me now a 10% builder's fee for the contractor that they hired to carry on the development of that property. I don't think that is included in our developer's agreement, and I was supposed to assume that the 10% cover everything. Yeah. So I don't have any way to justify the 10% builder's fee that they are charging me on top of the 10% developer's fee.
Right.
Right?
That's kind of like we were just talking about here. So is this a third party contractor, or is this somebody that's related to the developer?
Third party. They hire them directly.
And who's receiving the 10% fee, the developer or the builder?
Okay, there are two different 10%. The one that we agree under the developer's agreement is the developer's agreement, and that includes everything. The purchase of the property, the rehabilitation, out of all of that combined, we are going to pay them a 10% fee. But on a separate end, they're charging me a 10% builder's fee just for the rehabilitation portion of the project.
And 10% that developer is going to pocket, not that's going directly to the builder. It's not the builder's overridden profit.
That is supposed to be going to the builders. That's what I'm assuming because of builder's fee, but I don't think that should be right.
Well, if it's going to the builder, it's not necessarily a problem. If it's going to the developer, it definitely is a problem. If it's going to the builder, you still need to determine that. Normally that would be built into the contract price. So, if it's not built into the contract price, it's not. You might be able to allow it. I don't know, Stan. What do you think? Normally you would think that would be in there. So, it makes me a little nervous thinking that the builder sort of forgot to include their fee in there. So.
But that's my point. It's included within each line item. So literally, like built in the contract, not a separate line, right?
And sometimes builders who deal with public sector contracts do provide more data than they should. So I think one thing is kind of the cost reasonableness and whether they got quotes for this and whether this price is within, or if you've got someone else outside, an underwriter type, looking at prices and comparing this to what they think the rehab should cost. They may be providing very, very specific line item detail and not including their profit and overhead in a total contract price. Did they give you a breakdown of like how much they're spending on concrete, how much they're spending on lumber and such that?
I receive a full budget per line item as per the work specifications. And I am reviewing it right now. We don't have an outside underwriter, but I'm reviewing them along with the housing inspector, who is normally the person who reviews our budget. And it seems to be in line with the regular rehabilitation work that we do with any other contractor out there. But that already includes any developer's fee. Any builder's fee.
Right.
So a 10% on top of that, it seems like we are paying double.
Well, I think you're going about it the right way, and what I would do is to look at your other, the other work that you've done in the last few months and see if it's coming in, kind of in line with that. It sounds like you feel it is, as long as you don't see another place where they have stuck administrative or profit kind of fee, then it's perfectly fine to pay them. We want these people to make money. We just don't want them to make too much. But it's a legitimate expense as long as it's not duplicated someplace.
But that was my main concern. If it's not going to be an extreme enrichment due to the fact that this is supposedly going to two different people. One is the developer and one is the contractor. But since I feel that the regular fee without the builder's fee is what I would pay to any other contractor, I can easily just tell the developer that I'm not going to pay for the builder's fee, and that would be okay.
Well, if this is just a way that, as Stan has said, they're sort of giving you a lot of detail, and then they would be getting punished for opening up their cost structure to you. The builder. So let's just back up a sec, just one level here. So in a standard deal, a developer is going to make a fee, and a builder is going to make a fee. And sometimes it's the same company, so you have to be careful. But when it's two different companies and it's two different fees and they're both reasonable, you're okay.
Okay. So then later on I won't have to justify anything.
Well, I think you just have to, document what you're doing now, which is that you're verifying that by looking at other recent comparable costs, that this bid is in line with that, and that you don't see that there is a duplication of fees or anything like that. If they're different entities, the developer's fee is not going to the contractor and vice versa, and they both need to make some money to stay in business. So that's okay.
Okay.
All right.
Okay. One last thing. Since the one that I will be paying or is sending me the invoice for that will be the developer, how can I prove that that 10% actually went to the contractor?
Well, they've got to have receipts, and the contractor's got to sign off on the invoices and the payments and so forth. So, it should track back based on the total amount of the project and the payments that you're making. If you're paying 20% 5 times, and you'd have all your hard costs plus this fee, divided by 5 is what's going to the contractor, then you're probably okay.
You wouldn't want to compare the invoices to what you're paying.
Right.
Okay.
Yeah, the builder ought to be invoicing that. I mean, if that's where it's going, then they should be submitting something to request that.
No, I suppose that at the end I just can get the final release of lien from the contractor, and then that will be my proof.
Right.
Okay.
You probably hear from the contractor if he doesn't get his fee.
That's right.
Probably.
It'll be too late to fix it by then.
Yes.
Thank you, Tatiana.
Okay. Thank you.
And next up, let's go to Milan. Hi, Milan.
Hello.
Hi.
Hi, this is Milan Grozdanich from Lake County, Indiana. We are an NSP 1 and 3 grantee. And I've got a question about site, I guess beginning with site control. We are about to obtain title to 38 vacant lots in a subdivision that was originally a CDBG funded project. The nonprofit that was our partner is bailing out, and through reversion of assets, we're going to get back these ready to build on lots. And we thought that we could use, and it's in a target, in our NSP1 target community, one of them, and we thought that we could use some of our program income. We've been fortunate to sell a bunch of houses and have a good stream of PI to partner up now with a hopefully for-profit developer, I think is maybe the wise choice, to build a series of houses for us that would be sold to low to moderate income families. Now, since we own the properties outright, the lots, how do we make this work where we provide the funding to the developer? He makes his money from the development fee. We need to get the proceeds from the sale of these houses to be able to replicate this a few times over, because we need to, in theory, sell about 16 houses, the way we've got this thought out. So how do we rig this up? What kind of agreement to where the developer ends up with site control?
Milan, this is John. Let me ask you. So, I mean, what did you say the developer has to do that, or you can't transfer ownership? You can't transfer title for some reason, or you don't have title yet? Or I'm not understanding the.
We are about to get title. We don't have it yet. Okay. Reversion of assets is going to provide the title to the lots back to our agency, and that's going to happen in a month. Now, we were hoping to structure some sort of deal where a developer then would build and sell houses on our behalf, a few at a time. I mean, we need to do 23 of the 38 lots need to go to low-mod people. We believe we're going to do a deal with Habitat for about 7 of them. Our local agency says they could do about 1 a year for 7 years in this particular neighborhood. That leaves us 16. We've got about $1 million, give or take, I figure, of program income from NSP1 that we can invest in this project, and that should, if you do it 4 or 6 houses the first time, we get about 75% of the net proceeds of the sale back to us. 25%, 15%, let's say, is the developer fee, and the other 10% are the real estate commission, the holding costs, the insurance, that kind of thing.
So you don't want to transfer title to the lots to the developer?
Well, I don't know. I don't know how that's done, because I'm trying to figure out how would it work, because the subsidy involved would be us giving a credit at closing, but if we don't own the lots,
right?
If we don't own anything, then how do we provide some down payment assistance to these buyers?
Right.
Well, you said that
subsidy.
You indicated that the subdivision was ready to build on. So when you say developer, do you mean just someone who's going to build the houses, or is there more development type work that needs to be done? Are you just looking for someone
to build the houses? The infrastructure's all in. 15 of 55 houses got built, but it's stalled out, and the nonprofit that was our partner is bailing out of the deal, and so we need to do something else to meet the 51%.
So you're talking about a contractor. You need someone to build the houses.
Well, but I don't want to be a developer.
Sure.
Our office,
sure.
We don't want to be the necessarily contracting this work out. It would be much better with a sophisticated developer that knows what they're doing, that can, and especially with the NSP guidelines, where a developer then can go ahead and find his own contractors.
Sure.
The problem of us having to go trying to bid everything. You know what I mean?
Right. Sure.
It would be much easier to hire a developer to go ahead and do this construction work, since the infrastructure is now in. It's just we need somebody to build a series of houses, say 4 or 6 in the front end, and then as those sell, redo this again for 4 or 6 more until we hit the magic 16 that we need to make this thing meet HUD guidelines, because it was originally funded CDBG, and we have a waiver to go 51%. So, our magic number is 28, and we've got only 5 right now that are low mod. We know that NSP, even though it's NSP money, CDBG is underlying, so at the minimum we've got to do those low mod for that 28 houses, of which we need 23 more. You following?
Yeah, I was going the way Stan was thinking too. I think you could do this with a contractor. I think you could do it with a developer, and I think that the way that you have to set it up is through the developer agreement, which transfers the lot at some agreed upon price that's probably below its actual value, with the requirement that the developer pass that savings along to the buyer at the end of the transaction. I know that sounds kind of simple, so probably not quite that simple, but there's different ways of setting this up in such a way that you can, if there's enough money just in the lot to affect the subsidy that you need for the buyer on the back end, you can handle it just through the direction in the development agreement and the pricing on the lot. If that's not enough, you can always come in later and put an additional, homeownership assistance, soft second, or buy down the principal, or whatever you want to do. But the mechanism is the development agreement, and so what you might want to do, and I sort of recall talking to David about this. I don't know.
Right, we talked about this in Cincinnati a couple weeks ago.
that if we haven't ordered some TA for you, this might be a good time to have somebody come in and just help you put that development agreement together so that you're comfortable that it's covering all the angles.
Well, yeah, that's the eventual the plan once we get this reversion thing completed. There's some complications here locally with the tax authorities. Somehow they didn't have their exemptions filed. So we need to clean some things up before we take title ourselves and go forward. The question was, one of the things suggested was that we would provide the developer with a forgivable loan for the value of these lots, so that we would have still some control of our own, some financial grip on the lots while technically the developer would have site control.
Right.
Sound right?
You could retain ownership and just give them, right of, access or
option.
You could give them an easement, or there's any number of ways depending on who the developer is and how the agreement's set up to give them effective site control without necessarily transferring title until some later point. If it's a developer that's been doing this with you for the last 20 years and you're comfortable with them, you could probably structure it a little bit more on the front end. But if you figure that the cost of your land is typically going to run 20 or 25% of the selling price of the home, that might be enough. Just as a number, that might be an amount that would cover the type of soft second that you want to have coming in on the end, and then you're just really kind of making sure that it happens through the development agreement. But I think the idea of retaining title and giving them access to the property without transferring title until it's going to the ultimate purchaser is probably a little bit safer route. And there's different ways to structure that. I don't know, Stan, do you have some angles on that, or?
Only, were you planning on using NSP funds to finance the development as well?
Right. That's
so.
There's
then
no
you would
more
have another
CDBG left, but we've got a
right.
boatload of NSP program income that now at the tail end of the program would be great to, put the money in this particular community and for this purpose, since they are vacant lots that are fully, ready to build.
So using that and putting a lien on the property for the amount of the NSP funds that are being committed per house would be another way to help secure, if you did end up transferring the property, it would be another way that you could have some security that it would be used for the intended purpose. If not, you'd foreclose.
All right, well, okay. Well, that was the main question, though, is trying to get my head around this site control thing. I will be in touch with David and everybody in about a month or so for that TA.
All right, yeah. Well, the other thing you got to think about is on these transactions is the long-term affordability. So, if that if your amount of subsidy requires you to maintain affordability for 10 years through some sort of recapture provision, then you've got a number of things that you're going to have to deal with at the end of the process. So one way or another, you're going to be in it, both at the beginning and at the end. And there's a variety of ways to get there.
Right. Okay. Thank you.
All right.
Thank you, Milan. And got a question, a scenario here, and then a question from Leslie. She says, funding didn't come through for the entire construction costs. Can the developer transfer property back to the county to land bank, or can the developer renegotiate the development budget to hold the property? And what are the benefits or costs to either method?
Well, yes, you can renegotiate either to, allow land to be, held out of development or costs to go up. You'd have to document that, obviously. I'm not sure what the last part of the question meant with retaining. What was the last part of the question again, Ken?
Let's see. So Yeah, and what would the benefits or costs to either of those routes be?
Yeah, well, so I mean, in reality, costs don't always come out where we think they're going to. So you have to expect that some of these things are going to happen. I mean, you also have to make sure that you're not being, sort of paying for somebody else's mistakes and or things they should have done properly the first time. So you need to get. So that's one of the costs is or the risks is that you're overpaying one way or another for these things. But assuming that the costs are legitimate and they just couldn't, they were a little higher for a variety of reasons and they couldn't change anything, then I guess what I would be concerned about is where those lots are going to stay. I mean, you talked about a land bank. I mean, if that's a legitimate place to hold them and you have that capacity, I wouldn't think that would be a problem. You're not going to be able to show that you're meeting a national objective with those properties until you take them out of the land bank. But I mean, that is one way to do that. I guess I would just be mostly concerned about the validity of the costs and sort of the market appropriateness of the solution. So if the houses aren't selling, then it probably doesn't make sense to put more money in and build finish more houses. It's probably better to scale back, or the other way around. So I think you've got to look at what you can actually achieve with the amount of resources that you have, assuming that you can demonstrate that the costs are fair, and look at the trade-offs. And if the market's just too weak, then I think the land bank is a good way to go. If it's just that your costs are higher because the market is stronger, that's a different problem. But if you don't have any money, you still can't solve it. So I don't know. Stan, you got any wisdom on this?
Only other thing, one, what you alluded to was whether or not the development could be scaled back to something smaller, because it looks like the entire construction cost didn't come through for funding. I don't know if that was a grant or a competitive application, so whether it's possible to scale it back. And then I guess if I understand the last part about benefits, cost of either activity, there are costs for maintaining land. So if it does flip to a land bank, you've got to decide how you're going to handle mowing expenses, ongoing holding cost of land banks, how you would try to deter dumping on the site, and things such as that. So there are costs to having a land bank.
Yeah, that's a good point. If we're not hitting the question properly, just call in or write back.
And we've got a question here from Paula, who says, if a developer is receiving tax credits and is going to use some of this money to offset the cost of an NSP property and also reimburse the subrecipient all of the NSP commitment, will this be a problem?
I can't think of why that would be a problem, without knowing all the facts surrounding it, but it sounds as though the land was purchased with NSP, and now credits are coming in are going to take out the NSP money. So if it's a subrecipient, sounds like program income.
Yeah, there's some. We could probably use some more facts, but I think you're probably right. I'm not sure why we're talking about a developer and a subrecipient in the same. Unless one of them's taking the other one out. So, I mean, your ultimate kind of the worst case scenario is if you never meet a national objective with a property. So you bought a piece of land you were going to build a duplex on, and you never built it, and now somebody else wants to build a duplex on it, and you can sell it to them. But under the CDBG rules, because you've never met a national objective, you have to reimburse the program for the entire amount that you have expended on that project. So that's a little different than just selling it at market value and calling it program income. But as I say, that's your worst case scenario. If you've already met a national objective, or if this can lead to meeting a national objective, and you're just kind of turning control of the project over from one entity to another, that happens pretty regularly. So I'm a little unsure, just given the amount of information we have, and that's kind of the nature of these call-ins. We're limited, so you probably want to send this one through our Ask a Question line and give us a little more to go on, or call in.
Okay, let's see what else we can tell you here. So we've told you what's coming up, and look forward to seeing you at those. When you do leave the webinar, you'll be taken automatically to a feedback page, a short survey. We'd love your opinions, what you thought worked well, what you'd like to see more of in the future or less of. And so thank you in advance for taking a couple minutes to answer those questions. What else? Certainly would like to thank Stan for his preparation and expertise in joining us here today. Also John and Hunter, thank you for being here. Any final words before we wrap it up?
Do we have any other questions there, or did it look like...
I see no more questions.
Okay, all right. Well, David sends his regards. He's working on his deck this afternoon. He wanted to pick a data with at least 150% humidity, so we got one of those. But yeah, this is a complicated area, folks, and so Stan, I appreciate you doing this. Stan's been kind of teaching this class, so to speak, at some of the clinics that we've had, and it's given the number of policy alerts and questions that we get on developers and subrecipients and contractors. It's a complicated area, and it's okay to have questions, and it's okay to ask for help. So please do. We want your projects to work out. There's the only thing worse than finding out the project is not viable is finding out when you're halfway through. So try to figure that out. Try to eliminate most of those possibilities for failure ahead of time by getting an analysis of the project through an underwriting perspective. But call in, talk to your field office. They'll get us involved if they can't help. There's a lot of kind of fine points in this area, and policies kind of shifted over time. So we're not surprised that people have questions, and we wish we could just wave a magic wand and answer them all for you. But short of that, we'll take them one at a time and do the best we can.
Terrific. Well, thank you all for being here, participants as well, and we look forward to seeing you soon on another HUD NSP webinar. Take care, everyone.